Welcome to this personal tax roundup for this month. My name's Dean Wootton. First of all, we're going to look at a case concerning the statutory residence test, and it was anonymised. It was a taxpayer and HMRC. Now, the appellant was a UK resident and living with her husband and 2 children. On the 4th of April 15, she moved with her younger daughter to Dublin, and she claimed to be non-resident under the statutory residence test. Her husband remained in the UK in their former family home. He was going to move to Dublin on his retirement in a few years' time. Now, in 1516, she then received £8 million worth of dividends on shares in the family company given to her by her husband on the 16th of April 14. Now, she argued that she was non-resident when she received those dividends. HMRC said she was still UK resident under the statutory residence test, and therefore please pay us £3.1 million of tax on those £8 million worth of dividends. Now, the taxpayer argued that she was non-resident throughout the whole of 1516. The days that she spent in the UK in December 15 and 16 should be disregarded as exceptional. The days in December 15 and 16 would have put her over the limits, but she claimed they were exceptional and should be disregarded. Now, it was common ground that in 1516, under the statutory residence test for this particular individual, for her to be non-resident, she would have to spend 45 days or less in the UK. She had quite a few ties in the UK, so her days were lower, 45 days. Now, by the 21st of November 15, she had used up 44 days of that 45-day allowance. Now, the taxpayer argued that the 6 UK days in December 15 and 16, which would have put her over the limits, should be ignored. Now, that was due to the fact that she thought her presence in the UK was due to exceptional circumstances beyond her control. She'd actually come to the UK to visit her sister and family. Her sister was unfortunately suicidal at that point, and therefore she said she came over to look after her sister and care for her sister's minor children. Now, let's just have a look at this exceptional circumstances rule. Now, if the taxpayer is in the UK at midnight, that is normally a UK day, normally. However, we can ignore a UK day if the reasons for being here at midnight were exceptional. Now, to be exceptional, all of the following conditions must be satisfied. Now, the circumstances must be exceptional. The circumstances are beyond the individual's control. The circumstances prevented the individual from leaving the UK. The individual would not be present in the UK at the end of that day were it not for those exceptional circumstances. And the individual intended to leave the UK as soon as those circumstances permitted. Now, per statute, examples of exceptional circumstances include national or local emergencies and a sudden or life-threatening illness or injury. Now, if these conditions are met, then up to 60 days per tax year can be ignored. She only wanted to ignore 6, but up to 60 days can be ignored. Now, just generally, the 61st day would count as a UK day, even if exceptional circumstances remain. So effectively you get 60 exceptional days, and the 61st day, if you're still here, would be a UK day, effectively. But obviously she was well within those 60, because she was only asking for 6 days to be exceptional. But to get that in point, she would have to hit every single one of these conditions. Now, the tribunal were not convinced that she'd visited the UK solely to support her twin sister. She sought no medical psychiatric assistance during her 2 visits to help her twin. There was receipts from restaurants and supermarkets while she was here. There was no record of the reason for her visits and why they prevented her from leaving the UK. And they also held that alcoholism and depression, which unfortunately her sister was suffering from, were not exceptional circumstances on their own. But the need to care for her sister's minor children constituted exceptional circumstances. These circumstances were beyond the taxpayer's control. She was unable to leave the UK until that situation had been stabilised, and she would not have been in the UK but for the need to care for her sister and, it would appear, more importantly, the minor children, and she intended to leave the UK as soon as those circumstances permitted. So as far as the first deal were concerned, the conditions were met and the appeal was allowed. She was non-resident, and effectively the £3 million of tax was not payable on that £8 million dividend. Now, what this also shows is the exemption is wider than HMRC envisaged. When you look at their manuals, they state that the exemptions don't apply if you come back to the UK for a reason. They state you've got to be in the UK, and then effectively you don't leave because of exceptional circumstances. In this particular case, she wasn't in the UK, but she came back. And when you look at their manuals, they state the rules will generally not apply when the individual comes back to the UK. Well, in this particular case, they did apply when the individual came back to the UK. Now, these exemptions or exceptions, they are quite important recently, because what if you can't leave the UK because of COVID restrictions, for example? You'll still be here at midnight. Is that going to be an excluded day? You would think so. So they are important. So look at whatever days you need to fall within, and if there are some days where you think you've got exceptional circumstances, and you'd have to meet all those conditions to be so, then you could have some UK days ignored for the statutory residence test. Let's now look at a case concerning 3 taxpayers. These 3 taxpayers owned 200 ordinary shares in Breen Engineering Limited, so effectively 30% each. A 4th individual owned the balance, 10%. Now, Genbest Limited was inserted above Breen to equalise the shareholdings. The 3 taxpayers received 25% of ordinary shares and 600,000 of preference shares in Genbest. The 4th taxpayer was given 25% of the ordinary shares. So effectively the 3 had 25% and prefs, whereas the 4th had just the 25% ordinary shares. Now, these preference shares compensated the original shareholders for reductions in their shareholdings, and it did, in effect, facilitate their eventual retirement. Now, the issue was these preference shares were described as irredeemable, and the company obtained statutory clearance from HMRC that the transactions in security legislation would not apply. Now, during 1415 and 1516, Genbest repurchased the preference shares, and the taxpayers reported their disposals as capital gains, and they claimed entrepreneurs relief, what would now be business asset disposal relief. Now, HMRC issued assessments arguing that transaction security legislation applied, and that statutory clearance given, without mention that preference shares could and would be repurchased, made the clearance null and void. Effectively, the shares were not irredeemable. So therefore, and it was fully intended that they would be redeemed. And unfortunately, that wasn't disclosed to HMRC. Now, HMRC believed that the main purpose to the transaction was to obtain an income tax advantage for each of the 3 taxpayers, i.e. paying capital gains tax rather than income tax. Now, the 3 taxpayers appealed. Now, unfortunately, the taxpayers advised letter effectively made HMRC's case for them. In that letter, it stated that mentioning the plan to redeem the pref shares would flag up the matter to HMRC, and that if that was flagged, then advance clearance would be unlikely to be given. The repurchase of prefs were not needed to equalise the shareholdings, and the 1.8 million of cash consideration would be taxed as a deemed dividend. That's what the advisors said. Now, though it was part of the plan retirement plan, the deal was structured to produce a capital gain, which avoided a much larger income tax charge on a deemed distribution. One of the main purposes of the buyback was to obtain that tax advantage. Now, the very fact that key facts have been hidden from HMRC meant the advance clearance was void and the taxpayer's case was dismissed. And it's just one of those situations where if you're going for clearance, you have to make full disclosure. Otherwise, the clearance is just not worth the paper it's written on. So full clearance, whether you're going for a buyback of own shares or whatever, you have to have full clearance. And you look at this and you wonder, why this actually went forward. The advisors basically said, look, this is not going to work if HMRC know about it. And unfortunately, it was picked up and they got found out. So that is a lesson harshly learned. Now, in this case, quite a useful case, the next one. It's on entrepreneurs relief, or what would now be business asset disposal relief. Now, in this particular case, John Wardle owned 14.65% of an LLP. And this LLP was established to acquire, construct and operate a power plant using wood-based biomass. Now, in August 15, the LLP entered into contracts relating to the construction, operation and financing of the plant, including a contract to purchase feedstock from a supplier. And in September 16, the LLP applied to the Environment Agency for a permit to operate the power plant, and that was granted in May 17. Now, in November 16, just over a year from when the contracts were signed, John Wardle disposed of just under half of his LLP interest. He did report the gain, so no problem with reporting the gain, and that was reported in 1617, but he claimed he was eligible for entrepreneurs relief, or business asset disposal relief these days. Now, in May 18, HMRC opened an inquiry, and in March 20, they closed their inquiry rejecting the entrepreneur's claim, as the business, in their eyes, had not been trading for a year at the point of disposal. They didn't believe that signing contracts constituted the commencement of trade. Now, John Wardle appealed, arguing that the LLP's business was not simply to generate electricity. It included the actual construction and operation as a waste-to-energy business, procuring waste wood and then converting into electricity. And its principal revenue stream was the sale of electricity as a byproduct of processing waste wood. But it's actually the date of commencement that's a real issue here, because John Wardle argued, well, it's the whole lot. It's putting steps in place, construction, etc. That's when it starts, and that's back in August 15. Therefore, when I sold my shares, it's been trading for at least a year. HMRC, however, are saying that you don't start trade when you sign contracts. So therefore, we're not granting you entrepreneurs relief. So after the first two it went. The John Wardle chap, he produced only a limited number of documents to support his case. And I guess the key thing to really get across on this is that to get the entrepreneurs relief or business asset disposal relief, the company must have been trading for a year, or in this case the LLP, trading for at least 1 year. Now, they referred to quite an important case, the Mansell case, back in 2006. Now, in that case, the Special Commissioner stated, I conclude that a trade cannot commence until it has been set up, and the acts of setting up are not commencing or carrying on the trade. Setting up trade will include setting up a business structure to undertake the essential preliminaries, getting ready to face your customers, purchasing plant and organising decision-making structures, the management and the financing. So effectively, you need to get to a point where you can trade, and then you start trading from that point. Getting ready to trade, setting up to trade, is not commencement of trade. So at the time of disposal, construction of the plant had yet to begin, and it would take 2 years, followed by a 6 to 12 month commissioning phase to test the plant. Only then would the operator take over, and power generation would properly start. So the trade had not been set up and was not operational back in August 15. It was a long way from it. So consequently, the appeal was dismissed. So it is an unusual case in that they had quite a quick sale. And we may not have situations like that. So our clients may have built up their business much, much longer. But if it is short, and you're wondering, well, when did they start trading? When were they in a position to earn income? Then obviously look at this case, and particularly the Mansell case. The Mansell case seems to be a precedent for when a trade starts. It's not the getting ready or putting yourself in a position to trade. That doesn't count. It's when you are in that position and effectively you open your doors, effectively, for trading. Another case, we'll pick up the Michael Breen case. Now, Michael Breen accepted that he'd filed his 14-15 tax return 27 months late, but he challenged the late filing penalties of £10,665-ish. Now, he argued that a reasonable excuse, because in an earlier HMRC inquiry and criminal investigation, he got into a bit of bother. So therefore, he was not paranoid, but he's very concerned about sending in a return. And he wouldn't do that until he was absolutely confident that it was correct. Now, looking back at what he did do previously, in October 12, he received a notice from HMRC entitled Notice to Attend a Voluntary Interview Under Caution. He was suspected of having committed a criminal offence regarding an offshore investment account with a bank in Switzerland. Now, in 2013, a criminal investigation was replaced with a civil investigation. He did receive a COP 9 inquiry asking him to disclose the tax fraud he had committed. In February 14, there was an assessment for the 94-95 tax year totalling $520,000, and in February 15, there's a further assessment for nearly $1.1 million. So he was previously in a lot of bother, and he's a little bit concerned, apprehensive, paranoid possibly, about getting in future returns in case there are errors on them. Well, that was his case. Now, the first year held that mental health can constitute a reasonable excuse, provided that taxpayers' health had deteriorated to such an extent that they could not deal with their affairs, including preparing and submitting a tax return. And actually, at that point there, the first year stating that mental health can be a reason for late filings, etc., is quite useful for us in this day and age. If we do have clients that are struggling with mental health, struggling to get information to us, etc., that is a reasonable excuse. However, in this particular case, the first year tribunal found that to date, HMRC had acted in a proper manner at all times, and the taxpayer had not produced any medical evidence to support the claim. So essentially, if we're relying on that defence for other clients, then we would be best placed or best advised to have some medical evidence from the doctor saying the client, etc., etc. So we've got that excuse as to why they might be late. In this particular case, there was no such evidence. And so therefore the first year said, we don't believe he has a reasonable excuse. And consequently, his appeal was dismissed. Well, that concludes the personal tax roundup for this month. My name's Dean Wootton. Thank you for listening.